Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Inflation drops more than expected. So the Consumer Price Index, or CPI, measure of inflation was reported earlier this week as having risen 0.1% from the previous month and 7.1% over the past year. Now that's still relatively high, but it was better than the 7.3% reading that was expected. So markets cheered this news with the S&P 500 index rising more than 3% in early trading before paring its gains and finishing up only around 0.75%. Now, it's not hard to figure out why investors are so interested in better than expected inflation readings. For one, it's the boogeyman that got us into this market mess. And two, it makes it all the more likely the Federal Reserve will stop tightening monetary policy more quickly. On Wednesday, the Fed actually raised its key interest rate by 0.5% as expected, but it maintained a relatively tough stance toward fighting inflation going forward. Markets sold off, but only by a modest amount. Now, at this stage in the cycle, investors should be less concerned about inflation and more concerned about the rate of slowdown in economic growth. In fact, rapidly slowing inflation may in fact be a sign that the economy is slowing down at a faster pace. Not exactly something investors should be cheering on. Markets ultimately sold off toward the end of the week as they started to think more about that slowing growth. For this week's featured insight, the benefits of periodic investing. Well, one of the more important principles for building wealth through investing over the long run is to stay disciplined in making regular contributions to an investment portfolio. A 401k plan is a great example of this through automatic regular contributions from each and every paycheck. The key to making this work, however, is to ensure that you stick with it through thick and thin. Don't change your approach or invest less when you get worried about the markets going down. In fact, that is when the power of periodic investing shines the most. Now, for example, if you invested an equal amount in the S&P 500 index at the end of every single month during 2022, you would actually only be down about 1% on your cumulative investment, despite the index itself being down nearly 15% this year. Over the long run, dollar cost averaging by buying more shares for the same amount of money at cheaper price levels helps to drive long-term returns by taking advantage of market volatility. Looking ahead, Happy New Year. Last time on the Investor's Edge, I mentioned the concept of the Santa Claus rally phenomenon and the possibility that the recent strength in stocks might continue through year-end. Thus far into December, equity prices have actually softened a bit, but there's plenty of time left for Santa to still show up. Now, we're well off the market's lows for the year, but obviously 2022 is still a year that investors will be excited to put behind them, given the drawdowns in both equity and fixed income assets. And while plenty of challenges still lie ahead, we can look forward to a new year with a sense of hope and optimism, while dealing with each challenge as an opportunity to help advance long-term goals. I'd like to wish everyone a happy holiday season, a very Merry Christmas, and a safe, healthy, and happy New Year. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.